Hello and welcome to the Haines 2013 budget summary. What I'm going to be doing in the next few minutes is talking through the budget that the Chancellor of the Exchequer presented yesterday and summarising some of the main changes which were highlighted in the budget speech and in the accompanying documentation that followed the publication that followed the budget speech. Now this of necessity is only a summary of some of the changes that were announced. We don't have all the details at the moment. What will happen is that a draft finance bill will be produced in the next few days, and that will go through the parliamentary process, and then we'll have more details about the proposed legislation that will be introduced on the back of the announcement. Until then, all we can do is be aware of the changes that we're expecting to be introduced, and that is the purpose of this webinar. I'm going to start by talking about some of the changes that were introduced on personal tax. Now, every budget needs a headline-grabbing measure, and the Chancellor on this occasion chose to focus on the increase in the personal allowance to £10,000 with effect from April 2015. Now, the personal allowance for the current year, or for the year coming, for 2013-14 is already high. It's already £9,440. So that's only a relatively small increase to take it to £10,000. I expect to mention this because this was an aim of the coalition government when the government originally came into power, and the Chancellor was able to mention with accuracy that they will have achieved that aim a year ahead of their originally intended target. Compensating for that increase in the higher personal allowance, so the personal allowance going up this year and then going up again so that from 2015 it will be at a rate of £10,000. Compensating for that increase in the personal allowance, the higher rate band, the threshold at which individuals start to pay tax at the higher rate of 40%, is reducing further in 2013-14, so that will be reduced by a further £2,360 to £32,000, £32,010. And so the aim here is clear. The aim is to shift the burden of taxation away from those on the very lowest incomes and towards those, in this case, in the middle bracket. It had previously been announced that the top rate of 50%, which was introduced under Gordon Brown, was to be reduced to 45% with effect from 6th of April 2013. That measure has been confirmed in the budget, so that will be in statute, we expect, when the finance bill goes through Parliament. One interesting relaxation of the rules is in relation to loans made to employees, where a company makes, or indeed any employer, company or partnership or sole trader, makes a loan to an employee. The employee can be taxed as though they receive a benefit in kind. The benefit in kind is calculated by considering the rate of tax the individual might have paid on the loan were it on commercial terms, and treating that, measured over the year, treating that as the quantum of the benefit. It is then subject to tax and national insurance. That doesn't apply to all loans, because a loan at the moment of £5,000 or less is ignored for these purposes. Well, that £5,000 limit is being increased to £10,000 with effect from the 6th of April 2014, so not this year but next year. So that will take a lot of smaller loans made to employees outside the scope of that potential charge. A completely new change was introduced, although this had been announced previously, but this is a new concept. It's a tax-free allowance for certain individuals who give up certain employment rights. Now, when you're an employee of a company, you have certain rights that are associated with that employment. In return for giving up some of those rights, it would be possible for the employing company to provide shares in that company to the individual, with a certain proportion of those shares or a certain value of those shares not being taxable as a benefit in kind. Normally, when a company gives shares to an employee, the individual employee who receives the shares is taxed as though they've received a benefit like any other, and the benefit is calculated by valuing the shares, and tax and sometimes national insurance will then apply to the value of that benefit. Where an individual agrees to take on shareholder status, as it's termed, that individual will be entitled to receive shares up to the value of £2,000 without there being any tax charge associated with that reward. To be accurate, what happens is the individual is treated as paying £2,000 for any shares that they receive from their employer, up to a maximum of £50,000. In other words, if the employer provides the individual with £10,000 worth of shares, the individual is treated as paying £2,000 for that award. Therefore, it's only the balance, the £8,000, which is a taxable award. Another benefit arising from this rule is that the shares that an individual receives in that context will then be free of capital gains tax when the individual sells the shares, up to a maximum of £50,000 worth of shares that can be provided under that arrangement. Now, in return, the individual does give up certain employment rights. For example, the individual gives up the right to claim unfair dismissal, to claim most redundancy benefits, and to claim rights under the flexible working rules. So there are a lot of rights that the individual will be giving up in order to be able to benefit from this tax exemption. But for a lot of certainly more senior employees, those rights will be of little relevance, and that will be something that we have to do. Again, this is part of the government's move to encourage enterprise. It's intended to encourage individuals to think more like shareholders in the company, which they can become, think more like shareholders and business owners than employees. Now, it had previously been announced that certain reliefs would be capped so that the maximum value of the relief that an individual could use would be limited to a certain maximum amount per annum. Now, some income tax reliefs are already capped. For example, the relief that an individual can claim under the Enterprise Investment Scheme, the relief that an individual can claim for making a pension contribution. These are all capped. From the 6th of April 2013, other uncapped reliefs will also now have a limit. So this will apply to, for example, sideways loss relief and relief for losses in early years of trading, where from the 6th of April 2013 there will be a limit of £50,000 or 25% of total income of the individual as the amount that can be claimed in respect to that relief. This measure was introduced to target certain tax planning arrangements, for example film schemes and similar arrangements, whereby individuals were claiming large income tax deductions as a result of making certain investments in certain arrangements, which purportedly meant that certain losses from those arrangements were attributable to the individual investor, and that could make the investment particularly attractive for those with higher tax liabilities. The benefit of that kind of planning will now be significant. From April 2014, the relief that an individual can claim on a pension contribution is to be reduced. The maximum contribution that an individual can make will be reduced to £40,000 compared with £50,000 at present. And in conjunction with that, the annual lifetime allowance, the lifetime allowance available to an individual, effectively the maximum amount that the individual can have sheltered under a pension arrangement, will decrease from 1.5 million to 1.25 million. Now, there are certain complex transitional arrangements which will apply during the period when people are moving from the current regime and the current limits to the new limits. So there will be some protection for people making contributions earlier or where they may be affected by the decrease in the lifetime limit. But those rules are complex, but we're happy to explain those for anybody who needs more information. It's worthwhile bearing in mind that where an individual has a pension scheme and they haven't been making the full amount of contributions into the pension scheme for a period of in the last 3 years, it is possible to carry forward 3 years unused relief, so that with limits as they currently stand, an individual who's a member of a pension scheme but hasn't been making any contributions at all for a number of years could carry forward 3 years unused relief and therefore make a contribution in the current year of £200,000. Well, that total will reduce to £160,000 once the new limits are in place from 2014. A small technical change was made that affects individuals who are resident but not ordinarily resident in the UK. This basically moves from a position where their treatment was governed by a statement of practice to putting that treatment into the formal tax code, so putting this into statute. Very broadly, this affects individuals who are residents in the UK but not ordinarily residents in the UK, so they might be looking to return to their country of origin within the next 3 or 4 years. In that situation, the individual can be taxed on all the income from an employment where their duties are carried on in the UK, but can be taxed on a remittance basis for income so far as it relates to non-UK duties. And there are special rules that apply to when that remittance is taxed, where the remittance is made out of funds that are a mix of funds, where they've got an account which has some income from that overseas employment and some income from other sources. There are special rules as to how the remittance basis rules apply there. The new statutory rule will make it clear that there's basically a time apportionment of that. So it makes it a little simpler and puts it in statute. And that's something we've seen a lot, HMRC moving from extra statutory to concession to statements of practice to putting things on the statute book to give greater clarity. It's also been announced that HMRC are looking at allowing smaller businesses, that's businesses whose turnover is below the current VAT threshold, which is going to be increased this year to £79,000, putting them into a situation where they can prepare simplified accounts based simply on the cash in and the cash out. They won't then need to worry about the distinction between capital and revenue expenditure. They won't then need to worry about the recognition under normal accounting rules, for example in respect of debtors, creditors, and certain elements of expenditure which may or may not normally be recognised for tax purposes. This will simplify their tax calculations being based broadly on a cash in, cash out basis for the year. But that's only available for smaller businesses. And the final point to mention on personal tax is that a new statutory residence test will apply from 6th April 2013. This should make it easier to determine whether somebody is resident or ordinary resident in the UK for tax purposes. Previously, this would be determined by looking at HMRC practice, which was published in various publications that HMRC made available to the public. There was some confusion over HMRC's position in respect to certain items, and this is tested in a number of high-profile cases, including a case involving an individual called Haines Cooper, and a case, the Shepherd case. In those cases, really the question of when someone left the UK was in point. The idea of the new statutory residence test is to put that, is to make that completely clear and to put that beyond any doubt. The way this works is that there will be certain tests to determine when somebody is definitely not resident in the UK. So for example, if you spend fewer than 16 days in the UK, then you're not UK tax resident. There will be situations where somebody is definitely resident in the UK. For example, if somebody spends 183 days in the UK in a tax year, then somebody will be tax resident. If somebody spends less than 46 days in the UK and is not resident in any of the last 3 years, then you're definitely not tax resident. In other situations where you don't know whether somebody is automatically resident or automatically not resident, then you will look at the ties that the individual has to the UK. The more ties that the individual has, the less time they are allowed to be present in the UK and avoid being resident in the UK. And the ties will be based on whether they have family ties in the UK, whether there's accommodation in the UK, whether their work and business lives in the UK, the number of days spent in the UK, and whether the UK is the place where you spend more time compared with anywhere else. Depending on how many ties, the more ties, the less time you can spend in the UK without becoming automatically resident. I'm now going to come on and look at some of the changes that were announced in the area of corporation tax. Now, first of all, there's been yet another change announced to the rates of corporation tax, and this has made things quite confusing over recent years because successive chancellors have announced changes, proposed changes to the rate of corporation tax, and this is particularly the case under the coalition government. There have been announcements about what corporation tax would be in future years, but when it's come to it, when that year has come along, or we've got a little closer to that year, a further announcement has been made amending that previous announcement so that we're not going exactly down that route. To make it completely clear, from April 2015, the top rate of corporation tax will be reduced to what is the current small companies rate of corporation tax, 20%. There will only be one rate of corporation tax. Now, to cut through the complications with the different announcements over recent years, the rates are as follows. In the current year, we have a rate of 24% for a large company and 20% for a small company. For next year, we have a rate of 23 for a large, 20 for a small. From April 2014, we have a rate of 21 for a large and 20 for a small. And from April 2015, we have one rate, corporation tax, of 20%. That means that from April 2015, there is no marginal rate of corporation tax. So it doesn't actually matter whether a company has associated companies for that purpose. There will be no problem with determining whether a marginal rate, whether a company exceeds any particular threshold of profit. There is just one rate. The marginal rate, as we currently stand, works out to 25%. That won't exist anymore. There will just be one rate. So it is quite a major simplification to the corporation tax rate. It's part of the government's drive to make the UK tax system as competitive as possible to attract businesses to be resident here. A new announcement yesterday was in relation to NIC costs for employees. And it was announced that there will be the introduction of something called an employment allowance. And what this means is that any employer in the UK, for the first NI cost, can claim a deduction of £2,000 in the NI that they would otherwise pay. Now in the Chancellor's speech he made the point that this meant that somebody could take on a new employee, paying them over £20,000 and pay no NI on it, or could take on 4 new employees all on the minimum wage and not pay any NI on it. So it's to encourage really newer and smaller businesses to take that first step in bringing on an employee, taking on employees without running into national insurance charges that would otherwise be a disincentive to them. There were no changes to any other rates or thresholds, so nothing further to announce on the headlines relating to corporate tax rates. Hello and welcome to the Haines Watts budget summary for 2013. My name is Tom Moore, and over the next 40 minutes to an hour what I'm going to be doing is summarising some of the main changes that were announced by the Chancellor in yesterday's budget. We listened to the budget speech, we've looked through some of the documentation that was produced after that budget, and we've come up with the following summary of the main changes that were announced. Now this is of necessity only a summary. We only have so many details. There will be more details available when the draft legislation is produced in the form of the finance bill, and we expect that in the next few days. But for the moment this is intended as a summary of the main provisions that have been announced to provide some awareness of some of the changes that can be expected to be seen in the finance bill once that becomes published. The first area we're going to talk about is on personal tax. Now every budget speech needs a headline grabbing measure, and this year the Chancellor went for the increase in the personal allowance, which from April 2015 will be £10,000. That's significant because it meets the target of the coalition to take lower earners out of tax, take the first £10,000 of earnings for everyone in the UK out of tax. And with that being introduced in April 2015, the Chancellor can claim to have introduced that a little bit ahead of schedule. Now, the personal allowance at the moment is already quite high. And for 2013-14, the rate of the personal allowance will in fact be £9,440, so it won't be that much of an increase when it goes up to £10,000. Compensating against that, we've seen progressive reductions in the threshold at which higher rate, 40% tax, becomes payable, and that threshold will now be reduced for 2013-14 to £32,010. So the policy objective is clear. It's moving the burden of tax away from those on the lowest incomes to those in the middle brackets, as far as that particular measure is concerned. It had previously been announced the top rate of tax of 50% would be reduced to 45%, and that was confirmed in the publications produced immediately after the budget speech. So from the 6th of April 2013, the highest rate of income tax is now 45%. One small change, but a significant one for a lot of employees, is that the benefit in kind charge on loans made by companies or indeed any other employer to any of their employees has been slackened a little. where a company or any employer makes a loan to an employee and that employee doesn't pay tax or pays a very low rate, sorry, doesn't pay interest or pays a very low rate of interest on that loan, then there will be a benefit in kind. And the benefit in kind is calculated by comparing any interest actually paid, which is often zero, with an official rate of interest provided by HMRC, which varies from time to time. When you work out the annual benefit using that rate of interest, that is the amount to which the individual will be charged the tax, time apportioned if the loan isn't available for the whole year. Not every loan is affected by those rules. A loan under £5,000, a loan of £5,000 in fact, at the moment is not caught by those rules, and that £5,000 limit is going to be increased to £10,000 from the 6th of April 2014. An interesting measure that has been announced recently, it was announced before the budget, this was mentioned in the pre-budget report, but it was referred to again in the budget and in the papers accompanying the budget, is the opportunity for employees of companies to receive a certain share award free of tax, but in return for that employee giving up certain employment rights. And this is achieved by the individual adopting what is known as shareholder status within the company. Where the individual adopts shareholder status, it means that the individual can be given shares up to a value of £2,000 and there will be no income tax or national insurance cost on that first £2,000. To be accurate, a share award can be made to the individual of up to shares worth £50,000 and the individual will always be treated as having paid £2,000 for that share award. In other words, if an individual receives shares worth £10,000, they're treated as having paid £2,000 to receive them, and their taxable benefit is therefore only the balance of the difference between £10,000 and £2,000. So they are taxed on £8,000, and it is on the £8,000 figure that income tax and national insurance is due. There's an added benefit where an individual receives shares in those circumstances. The shares themselves are free from capital gains tax, up to a maximum award of £50,000. So an individual may receive an award of £50,000 worth of shares. Those shares can be free of capital gains tax, but there will be a benefit in kind on the excess over the £2,000 that the individual is treated as receiving, is treated as paying rather. Going on to some other personal tax measures, this is another one that we knew about before the budget. The government has been concerned about certain tax ideas taking advantage of loss reliefs that are available in the tax code, and has therefore decided to introduce a cap on the maximum amount of relief that can be claimed by any individual in any 1 year. Now, some income tax reliefs are already capped. So, for example, if an individual claims enterprise investment scheme relief on the investment that they make, there is a maximum amount that can qualify for that relief. From 2013, a cap will be placed on other reliefs, such as sideways loss relief and interest relief, to mean that an individual can't claim any more relief than £50,000 or 1/4 of their total income. So that is intended to curtail the activities of certain promoters who have been structuring ideas which are intended to give people an exaggerated benefit from the availability of some of those reliefs at the moment. From April 2014, the maximum amount that an individual can contribute towards a pension scheme and in respect to which they're able to claim tax relief will be reduced from £50,000 to £40,000, and in line with that, the lifetime limit, if you like, the maximum amount that an individual can have under a pension scheme shelter will be reduced from 1.5 million to 1.25 million. Now, there are various transitional provisions that will apply to ensure that people are protected, where they span the effect of these changes, but those changes will be fully enforced from the 6th of April 2014, and that means that in any 1 year, an individual can transfer into the pension scheme with full tax relief, £40,000, not £50,000. If taking advantage of the potential 3-year carryback, that means the maximum amount that could be put in would be, including the current year, £160,000, rather than, at the moment, £200,000. If you have a pension scheme but have not contributed to it for a number of years, you can take advantage of the unused relief for a maximum period of 3 years, plus the current year relief, to mean that at the moment somebody could, in theory, put £200,000 into a pension fund and get income tax relief on that. That will be reduced in line with the reduction in the annual limit, with the annual maximum amount. That will be reduced from 6th April 2014. One more technical change introduced by the government. This is to clarify the position of individuals who are resident but not ordinarily resident in the UK. So for example, an individual spends a lot of time here during the year, but actually their country of origin is elsewhere, and probably after 3 or 4 years they're likely to return there. So they haven't adopted a new life in the UK apart from for a relatively short period of time, but they are residents in the UK. People in those circumstances will pay full income tax and national insurance in the UK on an employment on UK duties, but where they're paid in respect of overseas duties, they can choose to have the payment from the overseas duties taxed on a remittance basis. Now this is enshrined in a statement of practice. That statement of practice has now been turned into statute. And it's partly been triggered by the combined effect, or by the interaction rather, with another change that was introduced affecting the remittance basis of taxation, where funds are brought back from an account which holds both unremitted income, which hasn't yet been taxed in the UK, and income that has been taxed in the UK. The new statutory basis will attempt to clear up the confusion caused by the interaction of those rules, but it will mean that a not ordinarily resident person can still benefit from the remittance basis in respect of income from overseas duties. And it was also mentioned in the budget that it's still proposed that HMRC will allow smaller businesses, that's businesses whose turnover is below the current VAT threshold, which is going up to £79,000, smaller businesses will be allowed to prepare their accounts in a much simpler way, prepare their accounts based on basically cash in, cash out. This will remove the need for smaller businesses to distinguish between capital and revenue expenditure, and will remove the need for them to take into account, for example, debtors and creditors and other adjustments that they may need to make to determine exactly what income they should recognise for tax purposes and what deductions they should recognise for tax purposes in a particular year. And the final point I'll mention in relation to changes on personal tax is that there will be, from 6th of April 2013, a statutory residence test, a set of statutory rules to determine when somebody is and is not resident in the UK for tax purposes. Now, in fact, this test has been available for the current tax year, for 2012-13, but by option, you can choose to have that test applied to determine your tax residence. It will apply to everybody by obligation from the 6th of April 2013. Now, the purpose of the test is that there has been some confusion in recent years as to how HMRC practice should properly be applied. HMRC practice was published and was thought to be well understood until certain cases went through the courts, in particular Gaines, Cooper and Shepherd, in which it became clear that the interpretation of HMRC practice was difficult, and HMRC would view things differently from the way that other people might. For that reason, the statutory residence test has been introduced, and the intention is that there will be clear circumstances when somebody is always resident in the UK, and there will be clear circumstances when somebody is definitely not resident in the UK, and then there will be a grey area in the middle, which I'll say something about in a moment. Somebody will definitely not be resident in the UK if they're here fewer than 16 days in the year. Somebody will definitely not be resident in the UK if they're here fewer than 46 days and they're not resident in the last 3 years. And somebody will definitely be resident in the UK if they spend 183 days in the UK. But there will be an area in the middle where it's not absolutely clear that somebody is not UK resident, and it's not absolutely clear whether if somebody is UK resident. And in those circumstances, the rules will provide that somebody's resident status will depend upon the period of time they spend in the UK, but also combined with that, how many ties they have with the UK. The more ties they have with the UK, the less time they will be allowed to spend in the UK before they are treated as being non-UK resident, so UK resident. And the ties will include family links to the UK, accommodation being available in the UK, whether the source of work is in the UK, whether somebody's work or business is in the UK, the number of days physically spent in the UK, and whether the UK is the main place where you spend your time. All of those will represent ties to the UK where they're present. And depending on how many ties an individual has, it will become easier for them with more ties to be treated as residents in the UK. The less ties they have, the less easy it is to be treated as residents in the UK. That's broadly how the statutory residence test will apply, and is intended to be something that removes a lot of the confusion that has reigned in that area in recent years. Moving on now to look at the changes that are announced in corporation tax. Now, the corporation tax rate, the top rate of corporation tax, has been reduced again, so that from April 2015, the top rate will be only 20%, the same as small companies' rates. So from that date, there will be only one rate of corporation tax. Now, this is an area that causes a lot of confusion because changes have been announced to rates of corporation tax, and those changes have themselves then been amended before the changes have been implemented. This is what the current position is. The main rate of corporation tax for the current year, 2012-13, is 24%, with small companies rate 20%. Small companies rate will stay the same all the way through to 2015, when it will be the same as the main rate. But the main rate is reducing as follows. From next year, 1st of April 2013, the rate will be 23%. From the 1st of April 2014, 21%. And this latest announcement that it will fall again in 2015 by a further percentage point, 20%. So there will then be only one rate of corporation tax. This means that the marginal rate that applies where companies have profits in excess of £300,000 but below 1.5 million will no longer exist. There will be no marginal rate. And that marginal rate imposes, at the moment, a slightly higher rate of tax to progressively withdraw the benefit of the small companies rate for companies once their profits go over £300,000. That will be gone, and that will represent a significant simplification. So, for example, it won't matter whether a company has associated companies for determining the rate of corporation tax. It will matter for other purposes, but not for that. As part of the government's policy of making simplification where it is possible, although to be honest there tends to be an awful lot of complexity added each year to the tax system, but where simplifications can be made, they do look for them, and of making the corporation tax system more competitive to attract business into the UK if possible. A new announcement put forward in the Chancellor's budget was the introduction of what's called an employment allowance. This is an interesting proposal. It's really aimed at smaller businesses and businesses taking their first step into the employment market, taking on their first employee or employees. The proposal is that rather than obliging a new employer to pay national insurance in respect of their new employees, the first £2,000 of what otherwise would have been the national insurance cost for that employer will be removed. The Chancellor made the point that's the equivalent of a business not paying national insurance in respect of one employee earning £22,000 or 4 employees on the minimum wage. So it's a single amount allowing you to not pay national insurance in respect of what otherwise would have been first £2,000 of national insurance costs for an employer, and I imagine something that will encourage a number of businesses to take on employees. There were no changes to any other rates or thresholds on corporation tax. We'll look at some of the other measures that were introduced on corporation tax. Now, a theme that has been progressing through successive budgets is tax measures to encourage green activity, to encourage lower levels of pollution, and there are various measures that are linked to company cars and the taxation of company cars, which have been intended to encourage companies to provide employees with lower emission cars than higher emission cars. There's been a further move in that direction, so there'll be new lower rates, there'll be new bans in fact introduced to apply to very low emission cars. The way this operates is that where a car is provided to an employee, a benefit in kind is calculated based on the list price of that car, broadly, multiplied by a certain percentage. And that percentage is very low for low emission cars. And there will now be a 5% band which will apply to cars, for example, with emissions of between 0 and 50 grams of CO2 per kilometre, and a 9% band for cars with emissions of 51 to 75 CO2 per kilometre, and a 13% band for other low emission cars, with after that a 2% increase for each rise in emissions of 5 grams of CO2 per kilometre from 95 grams CO2. And then there'll be a maximum percentage multiplier of 37%, which is a new level. So again, the system being skewed to encourage the provision of lower emission cars rather than higher emission cars. The gas guzzlers will, the car benefit on those is on the way up. Very low emission cars, it continues to be on the way down. The small change announced in relation to research and development R&D tax credits. The R&D tax credit scheme provides a very generous relief which, where companies incur expenditure on research and development, they can claim a deduction in respect of that expenditure, not of just 100% of the expenditure they incur, but in the case of a small company 225%, in case of a large company 130% of the value of the expenditure incurred. There are some very complex rules which deal with what type of expenditure qualifies and how it can be made to qualify. But in situations where a company doesn't have or wouldn't otherwise have a corporation tax liability, there is a new measure suggested where a large company will, instead of receiving a deduction for the expenditure in that area at up to 130%, they can instead claim a credit, a payment from the government. And it's now been suggested this payment will be 10% and will be fully taxable. So that's an above the line, as it's referred to, credit for companies undertaking research and development activity. The definition of what falls within that is unchanged, so the activity still needs to meet the criteria laid down in statute as at present, but the mechanism for claiming the relief is slightly more flexible for a large company than previously. It had been previously announced, but this will be brought into legislation from the 1st of April 2013, that a relief for income derived from patents will be available to companies. And effectively, this relief will mean that income derived from patents will, once the measure is in full use, will be only 10%. Now this is being introduced from the 1st of April 2013 and applies to activity on or after that date. But it will only be fully in force after a period of time, so it's being introduced over a period of time, but ultimately will produce a 10% rate on income derived from patents. One interesting point to note here is that where a company has a patented item, if that item forms part, is incorporated into a larger item, then the total income from that larger item can qualify for this relief. Now, that's quite significant. The example that HMRC give is if you have a car and it has a speedometer, and the speedometer is patented, and you sell the car and you have a lot of income from the sale of the car, it's income from the sale of the car that can qualify. That's a slight simplification, but it does give an illustration of how the relief can go wider than the obvious application to the individual patented item itself. HMRC has announced some changes, or the Chancellor has announced some changes to how businesses will be taxed when they leave the UK. Now at the moment, if a company is migrated out of the UK into another jurisdiction, there will be a corporation tax charge based on a deemed gain that the company will make on all of its chargeable assets. So the company will be treated as selling and immediately acquiring all its assets, and will thereby incur a capital gains tax charge which is subject to corporation tax. Now a case went through the courts recently in which, in the case of a Dutch company, this was challenged. It was challenged on the basis that this was contrary to some of the freedoms provided under European law. On the back of that, it was ruled that those laws, which were Dutch laws, were being applied inappropriately, and the laws needed to be different. HMRC is responding to that by redrafting its own laws that apply in this area. Now the laws are relatively complex, but broadly, there will be the opportunity to, instead of paying tax on immigration, paying tax only when those assets are ultimately disposed of. When those assets are ultimately disposed of, the interaction with local taxes and the application of double tax relief will need to be considered, but it will at the very least delay the time, or give the opportunity to delay the time on when tax is paid on the migration of a company outside the UK. Pretty much every year, the list of assets that qualify for enhanced capital allowances, these are 100% first-year allowances that are available where a company invests its money in acquiring one of these assets. That is changed and some additional assets are added to that. That's happened this year. It's quite a significant relief because 100% deduction is available if a company has already used up its annual investment allowance, which is being rated £250,000. If the company has already used that up, then this is a valuable relief. It applies basically to assets which are energy saving, which are green in nature, which contribute towards the government's objective of reducing pollution and helping the ecology. I'm now going to move on to some changes which have been announced in relation to capital gains tax. First point to make is that there was no change in the headline rates of capital gains tax. Everything has basically stayed the same, so we still have a top rate of 28%. We still have a 10% rate that will apply where an individual disposes of an asset and entrepreneur's relief is available on that disposal. And that's limited to a maximum lifetime aggregate gain of £10 million. So if you sell one company for £3 million, then you sell another for £8 million, £1 million of the second gain will not qualify for that relief. But the relief has remained unchanged in this budget. That means we've had a 10% rate available in the right circumstances since 1998. And pretty clearly that's something that has broad political consensus. And so I expect it's quite likely that we'll continue to have a 10% rate available in respect of some assets at least for some time. It's announced that there will be a new relief introduced, although we don't at the moment know what this is. It's just that the government are committing a small amount of funds, £50 million, to enabling this relief to be introduced. And all we know about this is that it's intended that this will apply on disposals of controlling interests in a business to employee ownership. So this might apply, for example, on a management buyout or some element of a management buyout. And it might be that there's a further reduction in the capital gains that would otherwise have been applied to the disposal by the business owner on the transfer to employees. But we'll have to wait and see for the details. That's under consultation, but that could be an added incentive to business owners to pass shares onto management when it comes to looking at an exit. Now last year the government introduced something called Seed Enterprise Investment Scheme relief. Very generous relief, gives a relief of up to 50% income tax where an individual invests in a company that qualifies. Very strict limits. The original limit was £100,000. They could qualify for that. Now when it was introduced, it was also announced that if an individual had a gain in the tax year 2012-13, that gain could be rolled over into the acquisition of SEIS shares. But only a gain in that year, only a gain in 2012-13, although it was intimated that that might be extended. That has indeed been extended to gains in 2013-14, and who knows, that could be extended in later years as well. But that is actually limited to 50% of the gain that's made. So in other words, if you make a £100,000 gain and you roll over £100,000 of that gain, half of the gain that you roll over will be exempt from tax. So you will get your tax back on half of that gain, but not all of it. If the gain is in 2013-14, the rule remains unchanged for 2012-13. And there is now a capital gains tax charge on a disposal by what's termed a non-natural person, where a non-natural person disposes of high-value property. That's residential property in the UK for £2 million or more. A non-natural person, for this purposes, you can read as company. There is some dispute as to what a non-natural person will include, whether it could include something else, but it certainly will include a company. And the way this will happen for a company is that if you have a UK company that owns UK residential property and sells that property, it will pay capital gains tax rates of 28%, not corporation tax rates. If it is a non-UK company where it would otherwise not have paid any tax at all. There may have been a special tax charge under Section 13 of TCJA that attributes the gain back to UK resident shareholders. There may have been that, but in the absence of that, it will pay no tax at all. That company will pay UK capital gains tax at 28% on the disposal. There are lots of exemptions, and the exemptions include, for example, where the property is let or where the property is being held for development. And I'll say a little bit more about that because that applies to another measure that was introduced under this same heading, but which applies an annual charge on this. So I'll come back to that when I say that. And similarly, I'll mention the SDLT charge that applies under that. There were three elements of the new charge applying to properties held by non-natural persons. Capital gains tax is one I've just described. The other two I'll touch on later. Now, unless you've been living on another planet, you can't have helped noticing that HMRC are conducting various high-profile campaigns against tax avoidance. The definition of tax avoidance is nebulous. It's difficult to determine what is in and outside that definition. But we see on the slide one individual who we know was a very high-profile victim of HMRC's campaigns in this area and the press attack on this area as well. That attack continues. Now, the first point on this slide is to mention something that isn't actually to do with tax avoidance at all. It's to do with tax evasion. Tax evasion is illegal, and tax evasion gives rise to a criminal offence. Tax avoidance is entirely legal. It's been attacked as not being acceptable, and it's been attacked on moral grounds. That's an individual choice. Tax avoidance is entirely illegal. Evasion is illegal. So tax avoidance legal, evasion illegal. The first measure is to do with evasion. HMRC are trying to prevent other jurisdictions being used as vehicles through which individuals can hide income that they receive and keep it outside tax. And for that purpose, there are bilateral agreements with individual countries, including Liechtenstein, Switzerland, USA, and new agreements have now been announced with the Isle of Man, Guernsey, and Jersey. And new staff have been taken on by HMRC specifically to get information from those jurisdictions to help them identify individuals who haven't paid tax on that income. And there'll be tough penalties of up to 200% of tax that hasn't been paid, has been evaded, or possible criminal prosecution, of course, because tax evasion, as we say, is illegal. So that first measure is to do with tax evasion, nothing to do with anything we do or speak to our clients about, or any of our clients do, of course. That is something that's completely outside, and hopefully nobody does that, but HMRC clearly identifies some people that do, and that's what that's aimed at. The Chancellor mentioned, and this has been trailed for some time, that there will now be a general anti-abuse rule. It's interesting that the name has changed from general anti-avoidance to general anti-abuse. I can think of some neutral or positive connotations of the word avoidance, for example, for the avoidance of doubt. I can't think of any positive or neutral connotations of the word abuse. So pretty clearly the name has been changed for a purpose. And it does reflect the nature of the rule. The rule is intended to combat the use of arrangements which are viewed by HMRC as being abusive. Not necessarily attacking arrangements which would constitute avoidance or tax planning. How do we define what is an abusive arrangement? Well, this is quite difficult. But HMRC have introduced some legislation which is intended to enshrine a definition of this. Broadly, we require the following. We require there to be some kind of arrangement, and we require it to be a reasonable conclusion that it wouldn't have been a reasonable arrangement when you take into account all the circumstances. It wouldn't have been a reasonable thing for somebody to undertake. Now, in reality, the general anti-abuse rule probably takes us little further than where we already are, with case law available to HMRC to tackle avoidance arrangements anyway. Where HMRC regard arrangements as contrived and artificial, there is already a non-statutory principle that allows them to challenge that in the court, and the courts, with varying degree, will be sympathetic to that where a particularly contrived arrangement is in place. The general anti-abuse rule may take us a little further down the track with that, but probably not much. It probably, in my view, doesn't change a great deal to where we are at the moment, and it will take some time before the General Anti-Abuse Rule, the GAR, is seen in operation, and before we know with any degree of certainty the parameters for the application of that rule. So for the moment, it's probably fair to say that it won't change a great deal, although some of the highly artificial planning which we have seen in the market in recent years will be blocked by that. That isn't something, to my knowledge, that any of our clients will have undertaken or been involved with, so it probably changes a little. Interestingly, last year the Chancellor announced that on stamp duty land tax SDLT, where there were contrived planning arrangements which were introduced, the government would look at introducing combating measures with retrospective effect. Now this is interesting for a couple of reasons. First, it reminds us that in normal circumstances it is very, very hard for HMRC to introduce anti-avoidance legislation that applies retrospectively. To do so is regarded as just going beyond the powers that any government should really take on. Now, of course, any government can do whatever it wants. It can introduce any rules. But in reality, governments have always shied away from introducing rules that have retrospective effect. There are very limited exceptions, and this is one of the few, where a government makes it clear that there is a particular area that has particular attributes where they do not want to see avoidance activity, and they can be clear about the type of avoidance activity that will fall within that, then they can announce that they will tackle that retrospectively if they see it. They've been able to do that previously in respect of very, very limited numbers of employment tax planning arrangements, and they're now doing that with SDLT as well. It's also surprising that promoters of these ideas still believe, despite that announcement, that this is something that they can pursue. There'll be the occasional arrangement which may work, but generally SDLT avoidance will be very, very difficult for a structured arrangement, unless it has been very carefully thought through indeed. HMRC have announced that arrangements using offshore intermediaries, offshore employment intermediaries, will no longer be effective, so they will be bringing forward mechanisms to tackle that. I won't mention any particular name for anybody who might be using an arrangement like that. Suffice it to say that there have been very popular and very widely used arrangements whereby somebody would effectively have an employment relationship with a company created for that purpose that enabled them to reduce the ongoing rate of tax they would otherwise be suffering in the UK, and would give them the opportunity to access that money in a very low tax way. Not surprisingly, those kind of arrangements are now being tackled. Interestingly, given the amount of press speculation and coverage that was devoted to those kind of arrangements, they're probably arrangements which HMRC had previously, well, pretty much accepted work. Now, I don't know that for certain. It's possible they'll choose to tackle some, but we've never seen any evidence of that to date. Now they're looking to block those. Interestingly, HMRC have announced that partnerships and the way that partnerships are used to allocate profits and losses to different members of the partnership will be reviewed. Now, they may have in mind a number of things. They may have in mind arrangements whereby, for example, a partnership has a corporate member, and the partners decide to allocate significant profits to that corporate member rather than to other members of the partnership. That could be one thing they have in mind. It may be that they have in mind more contrived arrangements, whereby certain investors in the partnership will be allocated all of the first year losses. We will have to wait and see. That will be open to consultation. It probably won't eventually impact on that much. It's already important to ensure where a partnership is used as part of the structure that an appropriate level of profit is available to the members of the partnership to reflect their economic activity or to reflect the input they have into that partnership. That's probably not going to change. So we will see what the consultation process produces, but I suspect the changes may not be that significant. Still other things on anti-avoidance. There was a particular scheme that was being marketed, and there were other arrangements which had as a byproduct a tax advantage for inheritance tax. Several ideas that were being marketed left an individual technically owing money to a third party. This is normally to some form of trust, an employee benefit trust or something similar. The individual would owe money to that, but they'd never be called upon to repay that. That would nevertheless give rise to a situation where the individual could claim a deduction for inheritance tax purposes for the debt in their estate on their death. Rules will be introduced to mean that those liabilities can't be taken into account in normal circumstances. It may still be possible to get the benefit of those by arranging for the physical repayment of the debt, with the money later being paid to beneficiaries, but we'll have to wait to see what the legislation actually says. It's not completely clear at the moment. HMRC have identified what they see as loopholes or problems where loans are made to participators in companies, and there are two things that they don't like in this area. Where loans are made to shareholders in companies, they don't like the fact that people have made the loans via intermediaries in some cases, for example through LLPs. Now in those circumstances there may have been a question as to whether that loan should have been caught by the normal charge or not. They also don't like the situation where a loan is made to a participator in the company, a shareholder, the loan is repaid, and then another loan is advanced in very quick succession. Now the normal tax position is that where a company makes a loan to somebody who's a shareholder in the company, that loan needs to be repaid within 9 months of the company year end, and if it is not repaid, then the company must pay 25% of the value of that loan over to HMRC as a sort of tax-free loan to HMRC. They'll get the money back when the loan's eventually repaid, but that's what they have to do to start off with. Where the loan is instead routed to an intermediary, there was an argument at least that that particular charging provision didn't apply. Where an individual shareholder repaid the loan to the company, but then was given another loan almost immediately, a bed and breakfasting, if you like, of the loan, then technically that also resulted in there being no charge. HMRC are introducing rules that they say will combat the use of those particular planning ideas in that context. Certainly the second one has been quite widely used, and we know that while HMRC inspectors are instructed to look out for that, it's not quite clear what they can do about it, apart from applying the doctrine that I mentioned earlier, case law doctrine that is available to them on avoidance. It's pretty certain that the GAR wouldn't affect any kind of arrangement like that, but these new rules which will be introduced, we'll have to see exactly what they say, but they'll be aimed at blocking that. There were two other anti-avoidance measures that were announced. I'm not going to go into them in detail. Suffice it to say that there were product ideas which involved companies taking advantage of group loss relief and also a loss relief where there's a change of ownership of the company. And there was also another idea which was taking advantage of the deduction that is available to a company where employees are given shares under a share scheme or whether they're just given rights under shares generally. Both of those particular planning ideas will have been blocked off by anti-avoidance, specific anti-avoidance legislation to take those out of use. It's worthwhile just noting in that context that where a company does make a share award to an employee, it does receive a tax deduction for the amount on which the employee is taxed. In the case of an EMI scheme, an Enterprise Management Incentive Scheme, the relief is much more generous. The relief is on the difference between the market value of the shares when the options are exercised and the amount that the individual pays to get the shares. So where somebody is granted EMI options where the shares are at low value, they exercise them prior to a sale when the shares are at a very high value, there can be a very big corporation tax deduction in the company. So that's valuable and that's worthwhile, that's worth bearing in mind. But in the context of this particular scheme, that's now been blocked. There are certain other tax matters which I'll mention. The first two are to do with inheritance tax. The nil rate band is frozen. The nil rate band will remain frozen for a number of years, and the possibility is that increases will resume once we are out of the current debt crisis, although when that will be is anybody's guess. Now the second bullet point applies where there are spouses, and one spouse is UK domiciled and one spouse is non-UK domiciled. The UK domiciled spouse is subject to inheritance tax on their entire estate, wherever it is in the world. The non-domiciled spouse is subject to inheritance tax only on their UK situs assets, only on their estate physically in the UK. When one spouse dies and passes their assets to the other, you would expect spouse exemption to prevent there being any tax charge on that. But spouse exemption, where a UK domiciled spouse passes assets to a non-UK domiciled spouse, has only ever been limited to £55,000. That's spouse exemption, remember. The nil-rate band is still there, but the spouse exemption available between those individuals is limited to £55,000. That spouse exemption is being increased to the value of the nil-rate band. The slide's actually slightly inaccurate. It says non-domiciled spouses to benefit from nil-rate band of £325,000. It's actually that the spouse exemption, rather than being limited to £55,000, is now of an amount equal to the nil-rate band, £325,000. That means that a UK domiciled individual could die with an estate of £650,000 and pass it all to their non-domiciled spouse without there being a tax charge. £325,000 would be covered by their nil-rate band. The further £325,000 would be covered by spouse exemption now available between domiciled and non-domiciled spouses. If their estate exceeded £650,000, if it was £700,000, £50,000 in my example would be fully taxable because it wouldn't be spouse exempt. And that applies from April 2013, April of this year. Previously, the spouse exemption would only have been £55,000. In conjunction with that, HMRC have introduced the option for a non-domiciled spouse to elect to be a domiciled spouse for this purpose. Now that means that when a domiciled spouse dies, and there would otherwise be a big inheritance tax charge because there is only limited spouse exemption, the non-domiciled spouse can elect to be treated as domiciled for UK inheritance tax purposes and therefore enjoy spouse exemption on that first death. It does of course mean that they are then domiciled for inheritance tax purposes when they die and their estate will be subject to inheritance tax. Will be very important though for individuals who are currently non-UK domiciled but are very likely in any case to be domiciled for IHT in the future. Remember that for IHT an individual can be deemed to be domiciled after only 17 years of residence in the UK. So there'll be people in that situation where electing to be domiciled, although it may accelerate it a bit, won't really make any difference. Now I mentioned that there was a special capital gains tax charge where individuals, non-natural persons owned property, expensive property in the UK. There will also be an annual charge that will apply to people who have, to non-natural persons that own property in the UK. And that non-natural charge will apply on a sliding scale. And to give an example, where the property is £7 million, you'll have a charge of £35,000 per year. That gives you an idea of what the sort of quantum of this charge is. So that's a sliding increasing scale depending on the value of the property. Now, it's a very interesting provision because although this appeared to have a great deal of potential impact for lots of people who had bought properties through companies, the impact may be limited because there are a number of exemptions that are available, reliefs and exemptions that are available. In particular, where the company owns the property but intends to let it, there will be no annual charge. Where the company holds the property for development, there will be no annual charge. How HMRC intend to police those reliefs is very unclear. So whether there will be a certain time beyond which they'll no longer accept that it is being held for development because you just haven't shown any signs of developing it, that's unclear. But it may be that lots of people can get within some of the exemptions available. Where it will apply is where somebody has a property held in a company, that property is then used by somebody as their residence without paying any rent. In those circumstances, the charge will apply and will be a significant charge. Allied to this is a 15% SDLT charge that applies on the acquisition by any such non-natural person of that property. It's worthwhile mentioning that from at the beginning of this year, the annual investment allowance, the AIA, was increased to £250,000, which means that businesses can acquire assets qualifying for capital allowances up to £250,000 without there being any, with a 100% deduction effectively for those. That's quite a generous relief, and the increase on that was a surprise when it was introduced, and will be a benefit for a lot of businesses. Just some of the
The
matters that
organizer has ended the session, and this call will be disconnected. Goodbye.